Welcome to the trade. Before we get into the technicals, let's have a quick look at what traders are watching. Prices of industrial metals extending gains, reflecting the impact of President Trump's 25% tariffs on steel and aluminium, with industries potentially struggling to source enough domestic material. Meanwhile, Mexico's government questioned the fairness of a 25% tariff ordered by the president on its imports, stressing that Mexico buys more steel from the US than it exports. US Federal Reserve Chair Jerome Powell, in his first appearance before Congress since the inauguration, vouched for the strength of the economy that President Trump has inherited, even as he deferred on questions about tariffs, Elon Musk's role in government, bank account safety, and other issues reflecting the unsettled nature of the administration's first weeks. Oil prices edging to a two-week high as sanctions raise concerns about Russian and Iranian oil supplies and on rising Middle East tensions, outweighing worries that trade tariffs might boost inflation and dampen global economic growth. And gold prices a little weaker, with investors booking profits following yet another record high. But of course, traders are bullish amid fears of a global trade war spurred by the new tariff threats. And Australia's Parliament has passed laws that would give production tax breaks for critical minerals and renewable hydrogen in a boost for its energy transition plans. Let's get into the technicals though. Chris Weston from Pepperstone joining me now. Good to see you, Chris. We can't forget that amidst reporting season, we've got an RBA decision next week. How is the Aussie tracking? I mean, it's up about 3 cents from where we were last week.
Well, if you look at the daily chart at the moment, it's really trading in a fairly tight range. It has been for a week or so now. We're sort of trading 63.50, 61.50. So you can see there, we broke the downtrend recently that was in place from January, and price is now just consolidating and trading in a tight range. So no different really from what we're seeing in euro dollar, cable to an extent. But yeah, you've got the market trading a nice range. So I think, on the higher time frames, if you're trading on the higher time frames, obviously if you're trading intraday, it's a different story. You'd be trading off sort of 30-minute, 1 hour charts. But on the higher time frame, what we've seen now is that series of lower lows and lower highs has been broken. We're just tracking in that tight range. So this is obviously one right now that you'd be looking to sell into the highs of the range, 63.50 and down the lows. But obviously the longer this channel goes forward, with volatility subsiding both on a realized basis and an implied basis, the larger the expected move that you'll probably see, and a lot of the sort of more aggressive trend that we could see. So right now it's a range traders market. When it does break out over a period of time, that could obviously set off a new directional situation. But obviously, going into the RBA meeting, obviously people are looking at this one very much a dollar play, but if Aussie's gaining against the Kiwi, which is probably your rate sensitive play, I think the market is saying that a cut next week is a done deal. On the 18th is a done deal. We've got a 90% probability of a cut. It's been above 70% all year in terms of the employed probability of that 25 basis point cut into the swaps and the futures market. So the market's saying right now that the RBA are going to cut rates on that meeting. It's not really a huge debate. Obviously, if they were to leave rates unchanged at 4.35, then you'd see a pretty aggressive spike up, at least initially. Where I think it's really interesting is kind of what's priced in further out the rates curve and to the end of the year. We got up to sort of 90 basis points or so of implied cuts coming through by the end of the year, and we're back down to about 78 basis points of cuts being priced in. So the market's really saying on balance now that we're going to get a rate cut next week on the 18th. And then there's probably two more rate cuts, 2 more 25 basis points cuts going into the end of the year, which given the economic dynamics we're seeing is probably about fair. I think we'll probably settle on that situation.
The other big focus, of course, is gold, Chris. The ongoing momentum towards 3,000, up something like 12% already in 2025. We know a couple of the reasons, but what are you seeing behind this?
Well, it's about the physical market, to be honest. Obviously you can see there from the daily chart there that we've had this beautiful move. It's just been a one-way move. The buyers have just stepped this up, and every pullback's just been gobbled up, and you can see it's just holding that 8-day exponential moving average. So that's really defined the trend that we've been seeing, and maybe that comes into question because we have seen a bit of exhaustion in the price action overnight, and maybe we do see a bit of a pullback. But right now, people talk about tariffs. Look, the idea about uncertainty from tariff risk is not, for me, the reason why this has been going up. It's the idea that precious metals will be taxed, similar to what we're seeing in copper. Copper's had a good run, but it's not because of growth and the usual sort of copper dynamics. It's because people are concerned that there's going to be tariffs being brought on. And if you have a look at yeah, everyone's been moving their gold into COMEX in the US, and COMEX stocks essentially, have gone up 102% since late December. So everyone's moving their money, their gold, into the COMEX in the US and away from London, to avoiding paying a tariff tax essentially. And so those stocks have gone up. In London, it's an absolute calamity what's going on there at the moment. The bullion banks literally have no gold in their vaults. They would then go to the Bank of England to go and get gold. But wait times now are because there's such a scarcity of physical gold and in London now, the wait times to get gold from the Bank of England have gone up to about 2 months. People are borrowing gold in the market from bullion banks and everything, but because of the scarcity, lease rates and short-term funding rates have gone up to 12-13%. So counterparty risk's a real issue there at the moment. So everyone's just been moving their gold over to the US. That's boosted the CME gold futures prices. We've seen big volumes there, and it's not necessarily about the tariff risk that this uncertainty, this friction that's going to come between nations. The fact that equity markets are all-time highs probably tells you that, but it's just to front run this, and the CME gold prices has really been the beneficiary of that.
Well, let's talk about the equity move and the tariff threats as well, particularly when it comes to Europe. And we know that there is a lot of concern about tit for tat here. What are we seeing particularly with the DAX?
Well, yeah, I mean, January, we're coming off a very, very strong January for all the European equity markets, and the DAX was probably the best one there as well. And again, you can see in the technicals that this has just had a very, very impressive move, maybe sort of climbing the wall of worry, so to speak. But yeah, this is in beast mode at the moment, and all the trend followers, all the momentum heads out there are probably max long on these European equity markets right now. And we're coming off, as I say, the best European equity markets. The DAX specifically had the best risk-adjusted returns of any asset class. Gold was pretty close to that as well, but certainly the DAX was the standout market in January. And we're sort of people who like to buy winners, people who like to buy strong, believing it could get stronger. This is the market that continues to work well. Now, it is a bit of a concern for me. I certainly wouldn't be looking to chase this right now because it's very hot and well subscribed to. But obviously we've got the reciprocal tariffs, which are going to be announced probably today. And the European Commission leader there has already said that they'll come back with reprisals, and that could be a bit of a concern. We've got German CPI, or US CPI tonight, but we've got German CPI and then European growth this week as well, which would just show how anemic the growth in the region is. But look, I mean, what do we like about this? Well, I think people have repositioned portfolios out of the US to a small extent into Europe because the US exceptionalism trade has been called into question. AI and tech has just lost its mojo at the moment. European earnings have been very strong relative to expectations. I think there's a belief out there that European growth concerns have troughed, and we could see better growth after the German election. So I think there's a mixture of repositioning that's taking place. Earnings have been better. And people just reposition those portfolios. So the question is, would you buy now? I certainly wouldn't. But it's too hot to be shorting at the moment. So one to watch. But this has been the outperforming market on a risk-adjusted basis, as well as gold, and we'll see if that can continue.
All right, Chris, always a pleasure. Thanks so much, Chris Weston there from Pepperstone. That does it for this edition of The Trade. Be sure to join us next time.